Unlocking Wealth with the S&P 500, a beginner's guide to long-term investing. Investing often feels like a distant dream reserved for the wealthy or those well into their 40s with millions in the bank. For many, the concept of building wealth through the stock market seems out of reach, overshadowed by the more tangible idea of buying a house. Yet the reality is far more accessible. Today, let's demystify investing in the S&P 500. A benchmark index representing 500 of the largest U.S. companies, and explore the potential returns for beginners embarking on their financial journey. This isn't just about numbers, it's about crafting a richer, more vibrant life through disciplined, long-term strategies. Understanding the S&P 500 and historical returns. The S&P 500 is often considered the heartbeat of the American economy, encompassing giants like Apple, Microsoft, and Amazon. It's a diversified snapshot of the market, offering exposure to various sectors from technology to healthcare. Historically, the S&P 500 has delivered an average annual return of around 10 to 11% before inflation, translating to about 7 to 8% after adjusting for rising prices. This data, spanning over a century, reflects the resilience of the market through wars, recessions, and booms. To put this into perspective, consider the power of compounding. If you invested $5,000 at age 16 and added $5,000 annually at a conservative 7% return, by age 30, you'd have over $133,000. Extend that to age 50, and it balloons to $736,000. These numbers aren't just figures. They represent freedom, the ability to travel, spend time with loved ones, or retire comfortably. The key? Starting early and staying consistent, letting time work its magic. Why choose a target date fund or S&P 500 index fund? For beginners, the simplest entry point isn't picking individual stocks or timing the market, strategies even professionals struggle with. Instead, consider a target date fund or an S&P 500 index fund offered by low-cost brokerages like Vanguard, Fidelity, or Schwab. A target date fund, for instance, is a one-stop solution. You pick a fund based on your expected retirement year, say 2050, and it automatically diversifies your money across stocks and bonds, becoming more conservative as you age. An S&P 500 index fund, on the other hand, directly tracks the performance of the index, offering broad market exposure at minimal cost. Why this approach? Diversification mitigates risk. Rather than betting on a single company, your money is spread across hundreds, balancing the ups and downs. Plus, it's hands-off. Set up an automatic transfer. 5 to 10% of your take-home pay is a good start, and let it grow. Investing shouldn't be exciting or gamified. It should be as mundane as watching paint dry. Avoid trendy apps that encourage frequent trading. They often lead to losses. Instead, check your account every 3 to 6 months on a desktop, not your phone, to resist the urge to tinker. Global and sector-specific impacts. The S&P 500 isn't just a U.S. story, it's a global one. Many of its companies operate worldwide, so your investment ties into international economic trends. A tech boom in Asia or a consumer spending surge in Europe can lift your returns. However, sector-specific risks exist. Technology, a significant chunk of the index, can be volatile during regulatory crackdowns or innovation slumps. Energy stocks within the S&P 500 might falter amid shifts to renewables, yet the index's breadth often cushions these blows, unlike concentrated investments. Practical advice for beginners. Starting is simpler than you think. Open an account with a reputable, low-cost brokerage, Vanguard, Fidelity, or, in the UK, Hargreaves Lansdown. Invest whatever you can, even if it's $100 a month. There's often no minimum for funds, and fees for fund investments are typically negligible. Automate your contributions to remove emotion from the equation. Treat this account as untouchable, not a piggy bank for bills or emergencies. Build a separate savings buffer for short-term needs, ensuring your investments can cook for decades. Mentally reframe investing. It's not about getting rich quick through crypto or day trading. Those are lottery tickets, not strategies. It's about steady wealth accumulation. Use tools like compound interest calculators, try MoneyChimp, to visualize growth. Plug in your numbers and watch how small, regular contributions snowball over time. Conclusion: investment implications and near-term catalysts. Investing in the S&P 500 via index or target date funds offers a proven path to wealth for beginners. The implication is clear. Start now, even with small amounts, to harness time and compounding. Policy-wise, governments could enhance financial literacy programs, breaking the myth that investing is for the elite. Near-term catalysts include potential Federal Reserve rate cuts in 2024, which could boost stock valuations by lowering borrowing costs for companies. However, geopolitical tensions or inflation spikes could introduce volatility, another reason to stay diversified and long-term focused. Ultimately, investing isn't just about money, it's about building the life you envision. Whether it's traveling in style or retiring early, the S&P 500 can be your vehicle. Set it, forget it, and let the market's historical strength work for you. Your future self will thank you.